Hello, federal viewers. We've been hearing a lot about the GST 2.0 rollout, and to share with us his thoughts is Vaitheeswaran. He's a lawyer, and most importantly, he's a member of the Tamil Nadu government's GST advisory committee. So, welcome, sir. Uh, to
Good.
start off, what would you say are the positives and what are the cons in this?
I think it's a fantastic step. Much has
Okay.
been given away in terms of rate rationalization. Uh, I would say it's probably like a mini budget the way it has gone about. It is much more than expected. Uh, all of us were looking at what is going to happen and how much of leeway does the government have. But looks as if the council has deliberated and taken a very calibrated decision because all states seems to be on board and they've looked at compromising as well as sacrificing some degree of revenue on the assumption that this will further consumption and bring in that differential revenue. So I think they've done some kind of brilliant calculation and looked at where all people will be really benefited. So I think some studies have deep studies have gone into it. Otherwise, you won't get this kind of output.
So, can we talk about the 40% now on luxury and sinful goods? One of my sources in the industry said that like cigarette prices most likely will not go up. He was saying this because the earlier tax itself was 28% and the cess was 22%. So put together it was more than 50%. And so currently it's now 40%, which means it's actually less than what it was taxed at earlier. So he says it's unlikely that cigarette prices go up. So in a way, is this really a tax cut that we're seeing?
See, it's a complex mechanism because earlier it was a combination of GST plus what we call as compensation cess. The GST will be normally like a tax collection, whereas the compensation cess is used for paying the revenue losses which the states suffer. So that is why the decision to actually implement 40% on cigarettes, gutkha, tobacco, etc. is actually deferred. It is not going to come on 22nd September. The fine print is that the council will decide as to when that implementation of 40 would come in. Until then, they would continue the existing system of tax plus cess. Because obviously, when it becomes 40, it becomes only a rate of tax. There's no compensation cess involved. So there is some decision which will come later on all these products as to when it will actually become 40%. Whereas the most of these products will continue at current rate of 28% GST plus the compensation cess, which will be used for settling the state's losses, if any.
Right. So, sir, across categories, then how much can you talk about the cess versus the current taxation rate, and does it result in something tangible? So, what was the earlier cess in other places like look at FMCG, cement, or insurance? So, then could you give us the comparable, and if this is really a cut in tax as it
No,
gets
let's
transferred?
look at first the rate rationalization by itself. That itself is a huge. For example, you picked up the word taking cue from what you said, cement. Cement was actually at 28% GST, which is one of the highest slab rates for all these years from implementation of GST, and it is one of the biggest demands of the construction sector as well as real estate sector to bring down this rate of tax to 18, because 28 is a very high rate, 14 to center and 14 to state. So 28 has come down to 18 without any conditions, fringes, or anything like that. That's a phenomenal reduction which will impact and benefit the real estate sector, the construction sector, the labor sector involved in that. And coupled with that, they've also brought down rate of tax for a host of other construction materials like granite, marble, wood veneer, and stuff like that, which would again help this particular industry bring down its cost. So there was never a cess on cement, but there was a cess on these beverages, like carbonated beverages, caffeinated beverages. Then there was a cess on luxury cars, high-end cars. There was a clear cess on these kind of common products. So those things are something which is now going to 40 in the name of sin. So the high-end cars are going to 40. The beverages that we think of, which is carbonated, which normally you would associate as not so good for health, would go to 40. I can't hear you. Your voice is gone.
No, it's fine. Please go on.
Yeah. So the 40 list is more like identified as sin items. So typically your non-healthy drinks are going there. Some of the high-end cars are going there. Bikes more than 350cc are going there. So 40 is the maximum you can live in GST law currently. That's the what we call as outer limit in the act as on date, unless they amend the act. So that's why that is that category. But I see much more benefit in terms of household items and regular items. For example, you get up in the morning, right from you wake up, you brush your teeth, toothpaste, toothbrush, wash your face, have a bath, or shampoo, soap. From that, you move on to the kitchen, your cooking items and various items which you do. All that has come down, slashed down big time in terms of rates of tax. And then you want to, health sector, if you look at your insurance has come down to zero, life insurance has come down to zero. So looks like common man, middleman, slightly more than upper middleman, if you can call it that way, middle class, if you can call it, all of them seem to have getting some benefits in the rationalization.
So, but are we so sure that these input tax credits, like, would they be passed on to the customer? Because today morning I was seeing an interview on the television where cement manufacturer is being asked by how much he would cut, and he said, yes, definitely, we will pass on, like, there'll be a 10-12 rupee cut, but actually, like, cement, I think, retails for something between 300 to 400 rupees. So that's not like really like a 10% cut, like, a 10 rupee slash. So will you, and also he was very non-committal as to when and how. So will we really see this being passed on to customers?
See, these are too early days for them to work out a calculation, see how it will pan down in terms of pricing, because there's so many other factors which go into cost structure and pricing. But no business today worth its salt can take a stand that I will not pass on the rate cut benefit, etc. Because customers are savvy, everybody is savvy, and therefore they would ask for relief wherever possible. And rate cuts will definitely get translated in terms of pricing as it goes down. Where you'll have a problem is where let us say there is a sector which has got exempted. For example, I have a child, I have a reservation on insurance getting exempted. If you have life insurance exempted from GST completely, then you should also look at what goes into their services. If you all the services that go into their services like reinsurance or other policies which they take or other services which they avail are 18, then without ITC their cost goes up. So their cost goes up, either the price would increase or their margins will be completely eroded. So you can't completely exempt an output activity and leave the input activity intact at taxable rates. Either you bring it down significantly or that also you exempt.
Right, right. That's very interesting. So now, can I go into some of the structural problems? Like, in the sense, I believe GSTR 3B, like, it's auto populated and it's hard lock the returns, and it cannot be edited once submitted. So, and so, how do you think we should upgrade ERP billing and return filing systems? Like, what safeguards exist if there are technical glitches or data mismatches happen during transition? So, would returns be corrected under the new regime?
As on date, you can still do it. There is a plan to make it completely frozen and not edited. But again, I have my reservations on that for the simple reason that your GST law is not a very simple law in terms of ITC. It's a very complex law as to when you can take credit, when you cannot take credit, what items you can take credit, what items you cannot take credit. For example, a vehicle will not qualify for credit for, let us say, a chartered accountant professional, but a vehicle will qualify a credit for a car dealer. So the same car will qualify as a credit for somebody, will not qualify for some other person. So, but the portal will not make all the distinctions. So whichever supplier sells car, it may get auto-populated as ITC, whereas you may not be entitled to ITC, you may have to reverse it. So till the law becomes completely smooth and everything is eligible for credit, you should have the facility of correction, because auto-population does not automatically mean it is ease of doing business.
Right, right. That's a very important point. Thanks for addressing it. And to go again into like the ease of ITC claim processes for MSMEs, which Tamil Nadu is highly dependent on when it comes to its economy. What about this address inverted duty structures where input tax exceeds output tax, thereby reducing block credits and improving working capital flow? Will there be like clearer eligibility or automation around ITC claims? And how quickly do you think ITC refunds will be processed under GST 2.0?
There are two decisions taken. Of course, they've indicated that these decisions will get operationalized by October and they will issue necessary notifications. One is in the context of refunds for exports. So they've taken a conscious decision that we need to free up the shackles around exports and get them released quickly, the refunds released quickly, and therefore 90% of your claim is likely to be automatically released without any inquiry based on risk profile and things like that. So it will be system driven, which means if you claim, let us say, 20 lakhs of refund of input tax for exports, 18 lakhs of that should come to you immediately is what is the plan in the new provision 2.0. Similarly, in inverted duty structure also, there is a plan for releasing 90% of your claim without verification, without checking, and checking might happen later, but at least you'll get your cash flows in place. So that's, I think, it's a very good move, which especially in the context of what we are right now facing in terms of tariffs and stuff like that, exporters will definitely see some relief in terms of cash flow.
So, and given that you are part of the state's GST advisory committee, what would you say about the impact on state revenues? How do you see this playing out?
See, I think all the moment you have a rate cut of significance, like 28 becoming 18, as in the case of, let us say, cement or cars for that matter, there would obviously be some degree of revenue dip that will happen both to center and state. It is going to be uniform in terms of a dip. But I guess from what I read, of course, I'm yet to see the impact of it. That a couple of months we needed to see the actual rollout. But from what I read, they're looking at something like the consumption offsetting the revenue loss significantly. The sales could be more, the GST collection because of the higher driven sales could be more, is what is their analysis. Again, I would probably say that this is probably a calculated gamble that, in fact, somebody is asking why it took them 8 years to bring these changes. It's a fair question. They could have brought it even more earlier. But probably they are waiting for the GST collections to reach a point where they have the luxury of bringing down the rates. Because that's how world over GST works. GST rates come down when the collections really go up. So when the collections really go up, you get a lot of elbow room to headroom to move around and bring down changes which you want and bring down reforms and things like that. And ultimately, it is also linked with inflation. So you look at whether inflation is high. If your inflation is not very high, then you can drive consumption, because you don't want consumption triggering inflation further. So probably you are at the right cusp where you have a low inflation, you have decent collection of GST, the country needs reforms, you are facing external pressures. So this is probably the right time for them to do these kind of reforms.
So, any aspect, before we wind up, any aspect of this GST 2.0 rollout that you feel has not been discussed about or has not been highlighted in what's transpired since morning?
No, I think while we talk about structural reforms and while we talk about refunds and registration being faster and simpler and all that, we should also look at some degree of certainty in law. So we should stop tinkering with the legislation for nullifying decisions, which has happened in the past. We should also look at assessments being simpler. See, nobody's case is that evasion should be recognized or evasion should be blessed. The right tax should be collected. The right tax should be properly collected. So when you have high-pitched assessments which are unreasonable or which are not fair, then it affects the ease of doing business. It opens up litigation in courts. Nobody is happy about it at any point of time. People are dragged all over the world, all over the hierarchy of judiciary to get that relief. And we have this peculiar problem of both state and center looking at the same assessee for the same year for different kinds of issues. So that is something which we can, I'm sure, with the kind of equanimity that exists in the GST Council and the federalism principles that are very clearly at display in all their meetings, they can work out a strategy and say, okay, you handle these files, we handle these files. If there is intelligence, we'll share the information, you take action based on that. That could be a much better approach than each person independently each authority taking independent action.
Is there anything that because many businesses in small businesses are proprietary led, so it'll be like one person's this. So is there anything to be worried in terms of like the income tax change when it comes to the assessment year versus like GST? Will there be any clash when it comes to your personal filings versus the what you're filing on behalf of the company? Given that the lines are blurred for many people.
Not really, but if you're an individual, your IT return would necessarily capture everything which is your income related aspects, which are not really in the GST radar or GST perspective. And if that is your focus of PAN, you'll have a single PAN, obviously. Then any questions based on comparing your IT return and GST return would be a waste of time, because you'll be only explaining things which are not even required. Whereas if you're a businessman and you're having a single PAN, comparing balance sheet and the GST returns would make sense, because what have we reported in this balance sheet, you've not reported the return, or vice versa. Those kind of questions can happen. But for an individual, he will have some other revenue, some capital gains he would have, which has got nothing to do with this kind of GST kind of a transaction. So scrutiny is based on IT return can be a pain. Scrutiny based on tedious statements in income tax can be a pain.
Sir. Thank you so much for joining us today, and it was such a pleasure to have you, and I'm sure our audience learned so much from you.
Thank you.